Good morning, Canberra, for Cam's Mortgage Minute on Wednesday, September 19th. Some more fallout from yesterday's real estate numbers. The TD's chief economist says that Canada's housing correction appears to be underway. The Bank of Nova Scotia came out as well and saying that the decline does not mean fears of a housing crash are about to be realized. What they are seeing, according to them, is at worst a soft landing. Basically, they feel that we should be able to avoid what's happened in the US and Europe simply due to the fact that strength of our domestic economy and our banking system. Both are certainly quite highly regarded and are doing quite well. The other thing which helps us is that we've mostly avoided the fallout from the financial crisis thus far, and that the numbers they are seeing are well within expectations. The other thing that to take of note out of all of this is that Canada's spending has slowed down. Basically, after the early part of 2012 till now, governments and consumers are starting to spend less. They're not taking on debt the way they were before because governments have realized after doing the bailouts from the slowdown that they've already got a lot of debt they've incurred, and households are starting to pay more attention to these numbers as well. For example, household debt is currently at 152% of personal disposable income, a number that rivals or gets close to the 160% threshold that US and the British consumers experienced right before they had the major corrections. So with the consumer and government spending declining in the first half of 2012, and the fact that the spending by consumers and governments accounts for 90% of the gross domestic product of our economy, well, at least it did in 2011, it would only make rational sense that we're going to see the economy slow. And that's what all predictions are, and that Canada's economy will only be probably growing at best by about 2% over the next 2 years. And that there's a lack of business investment simply delayed by the ongoing global uncertainty, which makes sense. Businesses aren't going to spend money if they're not sure what the future holds. So the other thing that we're probably going to see is that over in the end of 2012 into 2013, the economists expect that the export and investment outlook is going to improve and that the global economy in general over the next couple of years is going to start getting better. If it does, then certainly expect some rate hikes. I mean, we've been talking about rate hikes. This is like the proverbial boy that cries wolf. But at some point, folks, we're going to see some kind of an increase. And Mr. Alexander, who is an economist, predicted that the Bank of Canada will be faced with an increase, and that he expects that by the end of 2013, we're going to see a half a point increase, and in 2014, we'll see another half a point. Well, we'll see if he's right and if the other economists are right and if rates finally start moving up. But in the near term, we are certainly in for slow growth, folks, and we're probably in for some pretty flat real estate markets. If something changes, we'll see, but that's certainly the outlook starting 1 month into the new mortgage rules and the economy slowing in general and the fact that people are spending less. But it's not all doom and gloom. Maybe with folks spending less, they're going to start saving some more. And we talked about savings yesterday, and hey, what a great idea and what a great way to go. Anyway, it's been Cam for Cam's Mortgage Minute, and I will see you tomorrow.